The Federal Reserve raised interest rates 11 times. 11 times in less than 2 years. The most aggressive rate hiking cycle in 4 decades. The headlines told you inflation was cooling. The charts showed it coming down. The politicians said the worst was behind us. So why does your grocery bill still feel like a punch in the stomach? Why is your rent still climbing? Why does a meal at a restaurant that cost $15 in 2019 now cost $22? Here is the truth that the headlines are not telling you clearly enough. Inflation coming down is not the same as prices coming down. And there are deeper forces at work, forces that interest rate hikes were never designed to fix, that are keeping the cost of your life stubbornly, frustratingly high. Today, we are going to name them. Before we go further, we need to fix a misunderstanding that almost every news anchor glosses over. When the Fed says inflation is down to 3%, that does not mean prices dropped 3%. It means prices are still rising, just more slowly than before. Think of it this way. Between 2020 and 2023, prices in America rose by roughly 17% in total. That price increase did not disappear when inflation slowed down. It is permanently baked in. The egg that cost $1 in 2019 and peaked at $2 in 2023 is not going back to $1. The rent that jumped $400 during the pandemic is not coming back down $400. This is called the price level problem, and it is the first reason everything still feels expensive, even when the inflation rate itself has fallen. You are not imagining it. The prices really are higher, permanently. So inflation slowed, but it did not die. Why? 3 reasons, and each one is more stubborn than the last. Reason 1, housing. Shelter costs, rent and the equivalent cost of owning a home, make up roughly 35% of the entire consumer price index, the single largest component of measured inflation in America. And here is the problem. America has been underbuilding housing for 15 years. Zoning laws, construction costs, labor shortages, the supply of homes and apartments simply has not kept up with demand. When the Fed raises interest rates to cool the economy, it makes mortgages more expensive, yes, but it also makes it more expensive to build new housing. Less new supply, same strong demand. Rents stay high. Interest rate hikes cannot fix a housing shortage. Reason 2, the wage price spiral. During the pandemic, millions of Americans quit their jobs in what became known as the Great Resignation. Labor became scarce. Workers gained bargaining power. Wages rose, meaningfully for the first time in years. This sounds like good news, and for workers it was. But here is the economic reality. When wages rise, businesses face higher costs. To protect their margins, they raise prices. When prices rise, workers demand higher wages to keep up. When wages rise again, prices follow again. Round and round. Economists call this the wage price spiral. And once it is running, it is very hard to stop without causing a recession that nobody wants. Reason 3, structural cost increases that are not going away. The pandemic broke global supply chains in ways that have not fully healed. Companies that spent decades building lean, just-in-time supply chains learned a brutal lesson. Efficiency has no buffer when the world stops. So now they are building redundancy, holding more inventory, diversifying suppliers, moving production closer to home, what economists call reshoring. All of this is sensible. All of this is more expensive. And all of those extra costs get passed directly to the consumer, to you. Now here is the part of the story that makes people genuinely angry. While inflation was surging and ordinary Americans were cutting back, many of America's largest corporations were reporting record profit margins. The argument goes like this. Yes, costs went up for businesses during the pandemic. supply chain disruptions, higher wages, more expensive inputs, all real. But some companies, particularly in food, energy, and consumer goods, raise their prices by more than their costs actually increased. They use the cover of a broadly inflationary environment to protect and even expand their profit margins. On earnings calls, executives openly talked about their pricing power, their ability to raise prices without losing customers. Some economists have started calling this greedflation. Now, to be fair, this is genuinely debated. Many economists argue companies were simply responding rationally to higher costs, and that profits are a normal feature of a market economy. But the data is uncomfortable. Corporate profit margins in America hit record highs during the very same years that ordinary Americans were struggling most with prices. Make of that what you will. So, what do you actually do with all of this? First, stop waiting for prices to go back to where they were. They are not going back. Adjust your financial planning to the new price level, not the old one. Second, understand that cash loses in an inflationary world. Money sitting in a checking account earning nothing is money slowly losing its purchasing power every single year. At minimum, move your savings into a high-yield savings account that is actually keeping pace with or beating inflation. Third, think in terms of real assets. Historically, assets like equities, real estate, and commodities have outperformed inflation over time. Not as a get-rich-quick play, but as a long-term strategy for preserving the purchasing power of what you earn. Inflation is not just an economic statistic. It is a force that quietly redistributes wealth, from people who do not understand it to people who do. Now you understand it. If this video gave you a clearer picture of why your wallet still hurts, please like it and share it with someone who needs to hear this. Subscribe to Finomics, where we make the complex simple. I will see you in the next one.